Great. I'm Mark Trice. I'm joined here by fellow financial professional Jesse Hamilton. We're with Clear Vista Financial, and some of you listen to us on the radio program, the Spin Life Wealth Show on 11:20 a.m. in the Austin area, and we're glad that you joined us. But today we're going to get into our June monthly market update, and I'm going to let Jesse go ahead and kick that off and get the program started. Thanks for joining us.
So here's a quick agenda of what we're going to cover today. As we always do on these presentations, we're going to cover all the major indexes in the stock market, just to give you guys a picture of what's going on out there. It's a very volatile time that we are living in right now. So hopefully these pictures of actual indexes can help you understand where you're at and how it might affect you and your portfolio. We love educating people on what's going on in the market right now. So let's dive into that. Right after that, we'll do an economic update. We'll talk about some headlines, what's going on with the Fed and the jobs report and other economic data that is interesting and impactful to you. And then we'll cover your questions. So as Mark was saying, enter your questions on the side there and we will get to them at the end.
In the question box, yeah.
So starting it off, kicking it here with the Standard & Poor's 500, S&P 500 index. This is a very popular index that covers 500 large cap stocks in the United States. So major companies that you guys have all heard of before. When people say, how is the market today? A lot of times they're talking about this index. So this specific index was plus 0.01 May of 2022. And as you can see from this chart, that was a very volatile month that was kind of a U-shaped, and we saw a low there on May 20th that briefly intraday meant that we were in a bear market. Buyers came in and swooped in and made the price go back up. Here, I'll draw a highlighter here on that day, this day right here. You can see, can you guys see that?
Yeah, we can see that.
Awesome. Okay, cool. So that day right there, May 20th, I believe it was a Friday, we touched bear market territory, and then the buyers came in and pulled the price back up. So we did not close in the bear market. And then as you can see, the next week, the last week of May, we went back up. But
no, we're not.
The greater picture here is minus 20.93 if you go from the January 4th peak to the May 20th trough there.
And I don't know if you got this on a slide, Jesse, but year to date, that chart looks a whole lot uglier.
Yes.
Then that we were just excited to see. Really, when you look at last week, that was the first week out of the last 8 weeks in a row that the S&P actually had positive gains. 7 weeks in a row, the S&P 500 was in the negative for the week, and so last week was the first one. Does that mean it's over? Is the bear market over? We don't have any way of telling, but we do know there's a lot of headwinds ahead for the S&P 500, and that contains a lot of the largest companies in the United States. And we were just happy to see the month of May on the S&P 500 index actually eke out, albeit tiny, some gain. So.
Well, also one other thing that I wanted to mention is that the S&P 500 is cap weighted, which means that these mega companies that we all follow every single day, the bigger the company is, the more it's going to impact the price of this index. And the little tiny companies, they don't really impact it very much.
Yeah.
So moving in to our next index is the NASDAQ Composite. This is a tech-heavy sector. So some crossover between the S&P 500, but even more leveraged companies with more volatility. It can be more exciting or less exciting to be in these type of companies. But here's a snapshot of the trading days during the month of May. And the index was minus 2.05 for the month of May. But as you can see, it also had kind of a W or a U shape, however you want to call that. With that same day, May 20th, was a low. And so that's a part of a bigger picture that we're talking about minus 31.9%. That's almost 32% down from peak to trough, which
So
is
the
pretty
NASDAQ's
dramatic.
still in a bear market. It's still in a bear
Yes.
market. It's been in a bear market for some time because if we look at that, the peak of the NASDAQ was back in November,
Mm-hmm.
long before, kind of funny, long before Russia invaded Ukraine, and things like that. So, kind of makes you wonder what's really going on in the markets and the economy that's causing this tremendous pullback. I know those folks in Washington want you to think that it's Vladimir, and it's not really due to Vladimir, which we'll get into in a moment.
Mm-hmm. Yeah, you can also see this really steep uprise on the last week of May here. We even saw a gap right there between the second and third to last trading days in May. A lot of buyers came in, people got excited and said, oh, it's over, everybody back in. And so we
What's
saw that
generally the
price go
theme
up.
we see on television, Jesse, is buy the dip, buy the
Buy
dip,
the dip,
buy
buy
the
the
dip.
dip.
Interestingly enough, we were not seeing the large institutional players start buying then. This was retail investors saying, it's over,
Mm-hmm.
everything's safe, let's jump in. And we did this back in March too, where we said, in fact, it was, for those of you that watch Cramer, I don't even know the name of his show, Jim Cramer, he's the one that yells and says, buy, buy, sell, sell. He
He's always
really
throwing
says
stuff.
sell. Yeah, it does some crazy stuff. He was saying the bear market's over. This is back on March 25th. Bear
Right.
market's over. It's time to buy. And the S&P 500 went down over 8.5% in the month of April.
Mm-hmm.
So don't believe the pundits on television. Don't buy into the hype. For those of you that work with us, you know how we manage your money, and you know that if things get too risky, we start going defensive in your portfolio. And we've
Right.
been having to fight that fight since really the beginning of January.
Mm-hmm.
For those of you that are working with us, you know what we're doing. I'm glad you participated today because I just want to kind of explain what's going on.
Right. So let's talk about small caps just briefly, because probably if you have a balanced or some sort of mixed portfolio, you're holding small caps whether you want to or not. And these are companies that are publicly traded but are small compared to the big players. We're talking about like 50 million to a couple 100 million in market cap. So a lot smaller companies with smaller revenue. Some of them don't even have revenue. So it's a really interesting space to be in. That's not necessarily meaning that you need to go buy some, but the Russell 2000 index is what we follow here. And that index was down 0.37% during May of this year. And that's also a part of a greater 30.9% peak to trough, which is definitely considered a bear market territory.
Absolutely. And small cap companies are on every 401k menu, and you probably own them in some part of your 401k plan or portfolio. Our clients currently don't own anything in the small cap space, but almost every 401k has got that.
Mm-hmm.
Yep. Go ahead, Jesse.
So the last index we're going to cover right now is the long-term Treasury bond index. So
that one looks kind of ugly. Maybe you should just explain. A green candle is a good, strong buying day or up day, and a red candle is a down day. Now, the shadows on there, the long tails and things, those mean something to us, but we do them. We put them on here because it helps us explain what's going on. So, go ahead.
Yeah, I've got some buddies that I text every once in a while, pictures of me at work doing what I do. And a couple of days ago, one of them was honest and was like, "Do you think I understand what it is that you're sending me?" And I said, "Well, here, this is a simple version. Red's bad, green is good." And he's like, "Okay, great, I can follow that."
That's a good one. So what you can see here, Jesse, that's great. I'm glad you shared that because looking at the price of the long-term Treasury bonds, and this is the price of the bond, not the yield. What you're seeing is there's a lot more red than there is green.
Mm-hmm.
And from a pictorial standpoint, you can tell that bonds are still having trouble.
Right. So that specific index that we follow was down 2.42% for May. and that's part of a 27.4% decline from the December 6th peak through May 9th. May 9th being this date right here that I just circled.
Yeah.
So I hope that you guys find it insightful to actually look at the trading candles. I know you might not understand what they mean, but this is the market at work, opening and closing every day in trading. So
Draw a line there from that bottom, Jesse, up to the next to the last day. Just it doesn't have to be spot on. Just kind of draw a general line.
like a trend line?
Yeah, that's fine. I like a trend line there. You don't have to do that last one, but what you're seeing is that up until the last day of May, which was Tuesday, that bonds, or really last Friday, bonds were going up, interest rates were falling, and now we've seen the exact opposite happen again this last week. Bond yields are rising again. The 10-year Treasury, that's the shorter term, but it's what's tied to a lot of the mortgage rates and credit cards and car loans and things like that.
Mm-hmm.
That's ticked up 9% this week, 9% this week to 2.95%, and that's a big move in 1 week to the wrong direction.
Right.
When bond yields rise, the value of your bond goes down. And this is a big conundrum that a lot of investors have found themselves in, especially if you're sitting in your 401k and you don't have anyone helping you with it.
Mm-hmm.
What you're seeing is that the financial industry has told us year after year for the last 40 years that if you want to reduce your stock market risk, put more bonds in your portfolio. That's okay, except for the fact when the stock market's going down and bonds are going down as well. And so you get a double whammy, and we're seeing people that think they're in a moderate portfolio or a conservative portfolio, and they're down 15 or more percent. And that's dangerous. You need to pay attention to your 401k and make sure that you're moving. Now, even our clients see that type of movement in the market, but there's things that we do to try to minimize that, and that's something we can talk about offline if you'd like to. But
Mm-hmm.
it's people are going to be surprised when they open up their second quarter statements, if they didn't look at their first quarter statements, to see what they thought was a conservative portfolio to be down quite a bit.
Right. So Mark, this next slide, we haven't talked about it in the past, but I thought it would be really interesting for the people joining us today to take a 2-year historical look at the S&P 500 just to see where we're at. Okay.
Let's see that.
So here it is. I'll guide you guys along here. This beginning of the timeline is January of 2020, and everything's great. And then right here, we hear about this thing called COVID, and the stock price drops, and then we have this really great run up for 2020.
Really led by a lot of the tech companies.
Yes, tech companies that maintained a lot of revenue despite everyone staying at home. So we had these great run-ups. We had a little bit of turbulence here, maybe a little turbulence here throughout the years. These are normal pullbacks, normal little corrections that happen. But we make our way all the way to January of 2022, and specifically January 4th was the high right here. And then you guys can see where we're at for this year so far. We have seen big drawdowns, big run up, big drawdown over and over again. And then the month of April was extremely challenging for this specific index. You can see the drop off we've had right here. And now we're somewhere in the middle, and we don't know what's going to happen in the future.
A lot of times when you're in a bear market, you will have what we call bear market rallies. And really it's a short-term rally that lasts for a little bit, and then the market continues down. Now, we don't know if that's what's going to happen. We don't have a crystal ball. But if you've got questions, make sure you put those in the question box so that we can answer those for you. Jesse, go ahead.
So that's really all I had to say about this chart. I wanted to give everybody a perspective of where we're at and how volatile this market really is. That price, this is May 20th. If you do a straight line back, that price intersects again about March of 2021. So just for reference.
Yeah, so we've given back all those gains since March of 2021.
Mm-hmm.
So that's critical. That's something that we have to pay attention to, and we're not out of the woods yet. Jesse, why don't we go on to the next section?
Sure. All right, so let's transition here to do an economic update. So we're going to talk about what's going on in our economy in the United States, around the world, and we've got this airplane here. That's a big one, isn't it? 4 engines. It's going places. Is it a smooth landing, or are we going to have turbulence ahead? So let's dive in here, Mark. The
Sure.
first topic we're going to talk about is the Fed.
This is huge, right? Because the Fed has been raising interest rates. They raised them in March, 0.25%, and then they raised them again in May, a 0.5 percentage point. And this has a trickle effect to go through really what it costs banks to lend you money. It is not going to translate in the form of higher savings rates, higher interest rates that you earn on your bank accounts. That will take some time for that to trickle in. The forecast is here in about 2 weeks, when the Fed meets again, they will be raising interest rates another 0.5%, and they'll probably do that again at their next meeting. The challenge is they don't know how this is going to impact the economy, or whether it's going to slow inflation, because that is the hope, that raising these interest rates will kill inflation. Their target inflation rate is about 2% on an annualized basis, and right now we're at what, 8.9%. We haven't seen the May inflation numbers yet, I don't think, but I would expect them to begin leveling off. But the thing we have to remember is with inflation, just because it begins to level off doesn't mean we're not having inflation. We're still having inflation, and prices are still increasing, but maybe not as fast as they were the month before. So just because, if we drop down to 8 or 7.9% or so, that's still 7.9% inflation. And you're going to start seeing those numbers begin to trail off just a little bit, because they're 12 months in arrears. They're 12 months behind. It's a trailing 12-month figure. And of course, you're going to see that when we get into the summer months, when inflation was really beginning to take off, you're going to see that inflation is not increasing as fast, because we already had that increase built in. And so the other thing that the Fed is doing is, after our government and the Federal Reserve pumps $11 trillion into our economy, how do they do that? Well, it's kind of like printing money, but one of the ways that the Fed influenced the liquidity in our economy was they were buying Treasury-backed bonds and mortgage-backed bonds, thus putting a lot of cash into the system. Well, now they've got an $8.9 trillion balance sheet of bonds, and they have to begin to unwind that. In other words, to sell those. And so those, that type of selling of those bonds are going to really affect mortgage rates. And so, one of the things that Jesse, go ahead and talk for a second. I need to pull up something, but one of the things that's happening there is they're going to let some of these bonds mature. In other words, they're not going to sell the bonds off their portfolio. They're just going to let them mature, the longer term treasuries that are there, but they are going to have to sell some of these mortgage bonds. And that may cause mortgage rates to rise even more. Okay.
Right.
Go ahead.
Having a bond mature is different than selling the bond. It's kind of like dipping your toes in the water without diving all the way in, which it makes sense, because they want to make a smooth transition here. The phrase that you'll see in the news headlines is the soft landing. Are we going to have a soft landing? Everybody wants that smooth descent into the airport, and then you just touch down and nobody notices. But sometimes the plane comes down a little bit hard. The pilot can't do anything about it. So,
what the Fed is worried about is that this is going to cause a recession. And we already started seeing that. Unemployment is reaching really new lows. and the number of jobs that are still available out there, but there's a lot of hiring, but we're seeing it begin to level off.
Mm-hmm.
And that's a sign, and then some other things that we're going to show you in just a minute.
Here, I'll move to the next slide here, Mark. There's lots
No,
of data on here.
okay, hang on one second, because I want to talk about this, because
Oh, sure.
what we've got with high inflation and rising interest rates and a slowing economy is what we call stagflation. Now, for those of you that are on the call, and I know several of you, you probably don't remember this, or you were just a young adult when this happened the last time, in the late 70s, early 80s, okay? And that was a time where the economy was slowing rapidly because we were trying to create a recession artificially, and the Federal Reserve did that. They're trying to avoid that now, but this may be a little bit of a bumpy landing versus that smooth landing. Okay, Jesse, go ahead. Okay, so this is an interesting chart. We got this from the Dow Jones Corporate Bond Index and Global Financial Data. It is showing you really going back, if you look on the chart to 1980, Jesse, if you want to just kind of put your laser on that, the year 1980, you know, some of us remember that, and that was the beginning of really those interest rates that you're seeing there were beginning to fall through the next 40 years. So it's the trifecta here, right? We're seeing this rising rates, high inflation, and defaults. We're going to see a lot of small countries actually default on their bonds. So bonds and high inflation in the United States here. This is what the chart's showing. Bonds fared the worst among the two core asset classes during these episodes of high inflation. And the reasons are multifaceted, okay? Bonds face typically three primary risks. They've got default risk. So if it's a corporate bond, you know, is there a risk that the company might default on their debt? Until recently, in the last decade or so, we would say the United States would never default on their debt, but you know, they've had their rating downgraded. So default risk. You've also got interest rate risk. In other words, if there's rising interest rates, that can impact bonds, or falling interest rates can too. You've also got inflation risk. And inflation directly reduces the purchasing power of the bonds. And so when inflation exceeds the bond rate, or the coupon as we call it, bonds can experience real losses. And so what you're seeing here is that in 1980, we were entering into a 40-year bull market for bonds. And you know, you look at between 1945 to 1981, because of inflation and different things, the real yields on those were actually losses of 18% in bonds. And we've seen the last 40 years, this 40 plus years, this bull market in bonds. The little red line on there is the 10-year Treasury yield that we talked about. And we said that it's 2.95% as of Friday at the close. But you can see the interest rates are falling and the bond prices rising. And we believe here at Clearfield Financial, we believe based on the data that we're seeing, that we are at the end of this 40-year bull market in bonds. And so so you want to look at these things and see what's going on with your bond portfolio, because almost all of you, unless you're working with us right now, almost all of you have bonds in your portfolio.
Yeah.
So we see that bear market, or that bull market ending, a bear market starting. Because remember, I'm going to try to put this on the screen, so hopefully you can see this. You got a seesaw effect with bonds. On one side of the seesaw is the price of the bond. The other side is the interest rate, or the coupon. What we've had the last 40 years is we've had that coupon rate falling, or the interest rate. Bond values went up. Now we're seeing the exact opposite. Yields are rising, bond prices are falling. And so this has a tremendous impact on everything that you do, borrow, have in your portfolio. It's going to have a negative impact on that. So we watch that very closely to see how that is progressing.
Yes.
So let's go on to the next slide here. We had the jobs report.
Yeah, here's employment numbers coming out that kind of talk about how we've recovered a lot of the jobs from the first 2 months of the pandemic. which most people would think is great news, and in some ways it is. But
It is, yeah. And
yeah,
95% of the jobs lost or that we lost in the first couple of months of the pandemic have been recovered.
right.
That's good.
It is good. But what about the quality of those jobs and the longevity of those jobs?
So I think one thing that's happening here is I think that we've really reached peak employment. It's likely behind us, and the economy will begin to unwind. It may be slow. We might not be in a recession this year, maybe next year before we enter a recession, but at some time we will. But the big thing to remember here, and this is that silent killer, inflation.
Mm.
Wages are not keeping up with inflation, regardless of whether companies need more staff or anything like that. Okay, that's important to remember. If inflation is 8.9% and wages are rising at a rate of 5.3%, you're not able, based on the current income that you have, you're not able to purchase the same stuff for the same price. Your purchasing power is dwindling, okay? And that's a big key indicator that the economy may be slowing here. And we saw a lot of different types of data. There were gains in almost every sector of the economy when it comes to employment this last month, but we saw sectors like retail trail off quite dramatically, and that could be an early telltale sign that the economy is slowing. We won't know. We had in the first quarter, gross domestic product was down 1.5%. That was revised last week, Jesse, 1.5%. And we technically will not be in a recession in our economy unless we have another quarter in a row of downward gross domestic product. I don't know what that's going to be. Won't come out until mid-July. A lot of my economist friends have said, yes, we're in a recession because they look at data in different ways than you and I do. But, there's some concern. So there's nothing that you can do about it. You've got to basically make sure that your financial plan will adapt to those situations, especially the rising inflation.
Right.
Okay.
So real quick, let's talk about gas prices.
More inflation.
More inflation, yeah.
We have to update this slide. We didn't update it. We didn't update it yesterday. The average price nationally of a gallon of gas has gone up to $4.87.
Yeah, it
in the last
increased
few
overnight,
days.
didn't it?
$4.87. Yeah.
Yeah, on my drive this morning, I was just looking at some of the crazy prices around here Central Texas has, but I know it's not anything compared to some other people in other parts of the country. Everybody wants to blame it on Russia, but we don't really think that that's the heart of the problem. It's the inflation problem we're facing.
Yeah, and if you watch any type of national news or anything, that's what the Biden administration is going around. In fact, Biden himself had a talk yesterday touting the jobs growth, but in the same breath he said this won't continue forever, and he wanted to blame high inflation and high cost on Putin. The reality is that the invasion of Ukraine by Russia has only had a minor blip on the cost of goods and services. Gasoline was already rising very rapidly due to some of the decisions made by this administration and suppliers that are impacting this. This is not the greedy corporations. They tell you that if just greedy corporations wouldn't be so greedy, wouldn't have a problem. When you pump $11 trillion into our economy, that is going to have some significant inflationary effect. And there's no way to avoid it. And I don't understand it, Jesse. I don't understand why in the same breath our administration in Washington can say we're doing everything we can to fight inflation, and in the same sentence says, hey, please support my Build Back Better America bill that's going to pump an additional $3 to $5 trillion into the economy. Doesn't make sense. Doesn't make sense at all. And so, folks, believe what you want to believe, but I'm telling you that story doesn't pass the smell test. And I think that we're going to continue, even though we're going to have maybe inflation leveling off, we will continue to have high inflation for some time.
Yes.
This is going to take a long time to work itself out. On the
So,
positive side, though, people are traveling more, right?
they are.
Yeah,
And
it may not
real
be
quick,
pumping money in your gas tank, but it may be putting flying again.
right? Yeah, let's talk about flying. I thought this was an interesting headline. But real quick, I'm seeing a couple questions pop up. I encourage you to continue asking those questions, and we'll get to them if we have time at the end. So thank you to those who have.
Yeah,
But
put those in the question box.
yeah, in the question box. So let's move forward here. This was an interesting article. So Delta came out with their revenue forecast, and it's positive. It's high, and it's returned to pre-pandemic levels. But something really interesting is that they're projecting operating at 83% capacity of 2019, which means they have to increase the price by 17%. So if you go out and buy a flight right now, it's going to be extremely expensive. I bought one last week to go visit some family, and it was astronomical. So I just thought it was very interesting that these flight companies are having to increase their prices so much, and they're releasing data that says, oh, our revenues are back to normal, but it's because we jacked up our price 17%.
Yeah, I wanted to. We have a lot of stuff going on. We've got 4 kids, and they've got activities all throughout the summer. And I wanted to take a quick trip to Colorado because number one, it's cool, and number two, that's one of my favorite places to go visit. And then we put in the data to try to get airline tickets, and it was more than my mortgage. And so we're going someplace a little bit closer that we don't have to fly. But yeah, so a lot of I think Jesse's pointing out something very valuable. And when you hear these reports from companies reporting their financial performance, don't buy into the fact automatically that Delta is doing really well when you look at and dig through the weeds here and you see that their capacity is a lot lower. They're not flying as many flights, but they're charging more cost. You have to look at what that means for consumers. And so I think that, a lot of times, and I work for a Big Four accounting firm, so I know how financial reporting is done at the company level. And you try to make it as pretty as possible, right? But folks, you can't put lipstick on a pig and call it something else, right? You gotta look at the details and see what's really going on here. Things are slowing down a little bit, but travel is increasing though, so that's one of the positive things. Let's go on to the next slide, Jesse.
So here's the S&P 500 seasonality. Mark, you want to cover this?
Yeah, so this is really interesting. I know it's a really complicated table, but what this is showing here shows historical performance when the S&P 500 declined by at least 10% during the first 5 months of the year. And this goes back to the Great Depression. You can see, go ahead and highlight 2022. We don't know what the rest of the year holds, but the S&P is down over almost 13, 14%. If you look at this chart, what it shows is that the good news is that if we look at past performance, when this has happened, when we start the year with a decline of more than 10% in the S&P, historically, that has rebounded going into the year end. Now, for years with losses of more than 10% from January to May, the S&P 500 has posted average and median June to December returns of 6.3%, that's average, and 5.8%, meaning half or below that, half or below. Now, that's happened out of 11 occurrences since 1928. The best monthly returns for these periods occurred in July, which yielded an average and median returns of 5.7 and 5.5% respectively. Now, does this mean we're out of the woods? No, hindsight is not 2020 when it comes to the stock market, okay? You have to look at all the data, and we may be facing a little bit steeper climb in the economy than we've seen before. Here's some additional data that talks about that. Go to that next slide. This is kind of, I'm an economist by training, so I'm sorry. Some of these things are really interesting to me, and you're saying over there, Mark, you really are a nerd. So through the pandemic, okay, the demand for box packaging was so strong, right? Because we were ordering everything online, from Amazon to the groceries, et cetera. And so it's so strong that the time from ordering corrugated boxes to delivery to the wholesaler, that peaked at about 22 days in January, meaning that, or February, excuse me, meaning that it took on average about 22 days when I was Amazon and said I need to order some boxes so I can ship stuff to my customers. It took about 22 days to get to the manufacturer. With those order backlogs and shrinking and so forth, the lead time shrank by 3 days in the last month to 14. That was back in May, and industry experts believe that in June and July it could fall to below 10 days. Now, what that's telling you is that the number of orders that people are making where they're required to have a box to ship it in is falling. And so this could just be a leading indicator that things are cooling down. Let's go a little further here. Another leading indicator that we look at is the price of lumber. We look at the price of commodities as well, but the price of lumber is something that we look at. And some of you have heard me tell stories about me trying to build a barn and trying to buy lumber, and I waited too long, and the price of a piece of plywood went up by $40. And I just said, no way, I've got a hole in my roof in my barn right now, and I won't do it until then. That was back in 2021. And so we saw that decline rapidly in mid to late 2021, and then we saw it rise again, hinting that the economy was improving. And then really since the beginning of 2022, we've seen that fall off again. A falling lumber price is indicative of demand, and that's telling us that home building and things like that are beginning to slow down. I don't have a slide for this in this presentation, but just last week, we saw that new home sales in April fell 16% year over year. Okay, that's showing you signs of a cooling economy. Now, some of that, remember, we're comparing that to April of 2021. And what was happening in 2021? We were like stir crazy, and we're wanting to move and go to places. Our careers are changing. And so there was a lot of home buying last year. But we saw that those prices are beginning to drop a little bit and stabilize, which is a good thing for people that are looking for homes and stuff. So lumber prices are falling right now. And that's a critical figure to look at. Okay.
So here's a chart that shows the relationship between wages and inflation.
Yeah. So, Jesse mentioned this earlier. Maybe it was on the show. It's real hard to remember what we talk about, Jesse, when we have a radio show right
Sometimes
before.
I call it the wrong thing too.
So the Fed really has little control over today's goods inflation, right? It's driven by supply chains, COVID stimulus, the $11 trillion, and some of it by the war in Europe, okay? We keep our eyes on inflation all the time, which will be clear in this second half of the year. Now, wage pressures can become stickier and harder to reduce. We've seen wage inflation go up quite a bit, and you can see here the blue line there is the correlation to wages and inflation. You see it rising, meaning that wages are rising pretty fast, but not as fast as inflation. So persistent wage inflation, though, is really bad for financial markets. And here's some of that background. The correlation between wages and inflation has historically spiked during periods of high inflation, and continued upward pressure on wages may contribute even further to higher inflation, okay? So one thing begets another begets another. So we may see that these rising wages, which may seem good for us in our pocketbook, may actually be contributing to more increases in inflation. So we have to watch that pretty close. Let's go on to the next one real quick. Now, this one's a little bit more difficult to see here. I know it's real busy and the lines are a little bit blurry in there, but this is showing the different bear market rallies. And we mentioned that earlier. Are we just in a bear market rally, meaning that this is a temporary increase in the S&P 500, only to see it have it fall? And you can look here. If we go back to 2002, there were 6 bear market rallies before we finally climbed out of the bottom and began to start the next bull market. And you can see the first one there, Jesse. The market went down about 12.5% in that first pullback in that bear market. It rose another 8.6% from there, then went down another 27%, and then rose 19%, went down 36%, rose 21%, and so on. And the one on the chart on the right is the S&P during these same periods in 2008 and 9. We all remember that one. The 2000 one may be a little bit a while back, but the 2008, 2009, man, We all remember that one. And so you have these rallies where the market can increase quite dramatically, but only to have it peak, roll over again, and go down even further. We saw that in March. We saw the end of March, we saw the S&P peaking up. That was a bear market rally, and then we had it fall back down again in April and early May. So, you know, folks, we're not out of the woods yet. And
we
so
like studying these because it's very interesting and maybe can lead to some insight about how to see them in the future. But I mean, it would be really nice if it would just behave the exact same way, but it's just not. It's its own animal. It's a different bear.
Yeah, and then we can't go back and look at past bear markets and say, well, this one's going to last about 12 months, or this one's going to last 6 months. We don't know. There is no way to predict which way the market's going. So I just encourage you to be cautious when you hear the news and saying it's time to buy the dip and all that stuff. And we saw that week before this last week. We saw people jumping in buying the dip, only to have the S&P 500 fall in a shortened trading week, fall 1.2% this last week. And so is that going to continue down further? I have no idea. I hope it doesn't. I like to be able to invest like people normally do. But otherwise, we have to take really defensive strategies with our clients' portfolios to be able to try to help them maintain their assets, but also potentially grow those. And it makes it a whole lot harder when the market's going sideways and up and down. And that is a challenge for us. And we think we do fairly well with that, but it's still a challenge. And you're going to see volatility in your portfolio. I don't care who you're with, you're going to see that volatility. The thing that we have to be cautious of is, I said, the government says, oh, we're coming in for a smooth landing, to go back to our airplane analogy. I think we're going to have a little bit of turbulence. It might be one of those bumpy landings, but I think our economy is resilient. We will get through this. We will see things improve. We will see inflation hopefully eventually begin to subside, but that has changed how you need to plan for the future. When we do our financial forecast and our financial planning for our clients, we have to assume a certain rate of inflation, right? And historically, that's been 2.6%. We put that there, but now things change. And when we're at inflation's at 8.9%, that changes the ball game. And so you want to make sure that you're touching base with your advisor for that. Right. So Jesse, do we have any questions that we want to address here?
Yeah, let's dive into just a couple questions.
Remember, you can put those questions in the question box.
Yeah, it's not too late to ask them.
Yeah.
So go ahead and enter those. But let's start off with one question relating to, is it a bad time to buy a house?
Is it a bad time to buy a house? Well, that depends. What we're seeing right now is we're seeing affordability of homes fall, meaning that the median house price, the average house price, and I looked at data for Austin, the Austin Metro the other day. The median house price, or average house price, is about $300,000 for a typical home in Austin. And with interest rates rising, that means that the affordability of those houses, meaning it costs more to get that mortgage, that's going down. And so what you're seeing is you're seeing a lot of people, after a crazy overheated market, you're seeing a lot of people having trouble being able to qualify for the mortgage. But I would tell you, you shouldn't try to time that. If it's time for you to get a different house, you should go ahead and do that. Homes are still selling. Homes always sell. And they may be selling at a slower rate. We're seeing the number of days on market fall a little bit. What that means, though, if you are a buyer, that means you're beginning to have a little bit more negotiating power, okay? Whereas before, up until the last couple of months, if you were a buyer, you had to go in and make an offer that was more than the asking price, and if you could pay cash, that was better than getting a loan, because you're competing with people from California, all right? So you got to make sure that you are prepared to do that. Make sure you talk to a qualified mortgage broker. We can introduce you to some, depending on where you live, but you want to have that all planned out before you start to buy it. If you're thinking about selling, it's still a good time to sell. just know it may take a few days longer than anticipated. I mean, things are not selling on the first day like they were. They may be taking them a week or two. So just be prepared for that. And I think it's still, if it's time for you to buy a new home to you, it's still a good time to do it. I don't
Yeah.
know what the future holds, and might as well go ahead and do that. What other questions?
Okay. We have a question from a friend and somebody that we know, but a lot of people are asking this. We've had people call in and ask this question, so I'd love to hear your input, Mark. At what point should I lower my 401k contributions back to 6%, which is the amount that my employer matches?
Okay. I think a lot of people are concerned that they're putting money to work in a falling market. And my question is, why are you slowing down your contributions? Because unless you're planning on retiring later than you originally forecast to retire, you need to keep putting money to work. The way to think about it is when you're taking money from your paycheck to invest in your 401k at work, you are doing something we call dollar cost averaging. And so that means some months I'm paying a little bit more money for the same mutual fund, and some months I might pay a little bit less. And right now, when you think about that, you're buying those mutual funds in your 401k plan at a discount. They're on sale, right? They're on sale. Now, we don't know what the future holds. We do not have a crystal ball. I wish I had one. We do not have a crystal ball. We cannot foresee what the future holds, but you're putting more money from your paycheck to work for your future retirement, which for some of you may be 25, 30, 35 years away. When the market's going down, keep contributing. Don't change that at all. So that's the long-winded way of saying, don't change your contributions. Keep going. Keep going.
Yeah, I'm immediately reminded of the different phases of somebody's financial plan. And when you're contributing to a 401k, you're very much in the accumulation phase versus very different than the preservation phase, which is where you might want to take a look at downturns and really manage your risk in a more aggressive way.
Yeah. But good question, though. I wouldn't change anything for that participant today. I would not change that. I'll keep going the way you are. So, Jesse, do you see any more questions? We might go to the final slide. If we don't see any other questions.
Here's some contact information. Give us a call anytime during the week. We're happy to have these conversations with you. Talk about the markets, talk about your portfolio. That phone number is 800-491-4508. You can shoot us an email at info@clearvistafinancial.com. We would be happy to respond to that. If you want to go ahead and just get on the calendar for a quick phone call, or if you want to come visit us, calendly.com/Mark Trice.
Yeah, and that's the easiest way to see when I'm available. We recommend that you schedule just a 30-minute go-to-meeting like this or a phone consultation. But and if we need to meet in person, we can make that happen. Someone from our office will call you to confirm that and stuff. But you can go ahead and see when I'm available, and we can be happy to talk to you. So I think there's a lot of concern out there about the economy and markets and stuff like that. But folks, we encourage you to realize that we think that there are good signs out there. There are some concerning signs, and we don't know what the future holds, but we do know that things will be okay. If you're working with a financial advisor, hopefully they're helping you navigate this time, because it really is unprecedented. This is not like before. But if you don't have a financial advisor that you're working with, give us a call. We can either help you or we can refer you to someone in your local area that will help you. Jesse, I think we'll call it a day, and we want to thank you for participating on today's monthly market update. We do this every first Saturday of every month. So our next one will be around July 3rd, I think, or maybe that's July 2nd. I can't remember. I don't have a calendar in front of me. But that first Saturday of every month at 9:15, we will give you our update and our prognosis, if you will, of what's going on in the markets and our economy and how that impacts your financial goals. But from Jesse and myself, I want to thank you for attending. Have a wonderful remainder of your weekend, and happy summer.